Press the bell icon on the YouTube app and never miss another update.
Yeah, there are certain interesting stock market terms that I will like to discuss in this particular episode. They're very simple terms, but yes, you should be aware about that as we start our journey finally with portfolio management. Now, the first term that I want to discuss is bull, and related to it itself is bear. Bulls and bears. These are two terms which are popularly used in the stock market. Even when we are doing trend analysis in stock market, so many a times we say that the trend is bullish, trend is bearish. So we should really understand what do we really mean by a bull and a bear. Now, a bull and bear are basically terms which are used for an investor. Yeah, you'll really be surprised. An investor can be a bull, or an investor can be a bear, or even a trader can be a bull, or a trader can be a bear. Now, we understand bull as an investor who is expecting that markets, an investor that expects that the stock markets will rise, while a bear will be understood as an investor that expects that the stock markets will fall. So if you are someone who is expecting that the markets will rise, we consider yourself to be a bull. And if you are expecting that no, the markets have risen significantly, now it is time for the markets to fall. If you are an investor who is expecting a crash in the markets, then consider yourself to be a bear. So bull is someone who is expecting the markets to rise, bear is someone who is expecting the markets to fall. So when we say bullish trend in the market, that means we are expecting the markets to rise. When someone says, or you read somewhere or you hear somewhere that markets are in the grips of bears, many times Economic Times and a lot many other business newspapers, they make these kinds of headlines that market is now in the grips of bears. That means we are expecting a bearish trend in the market. We are expecting a continuous fall in the market over a period of term. And yes, when I say markets, I mean the stock markets over here, of course. So bull and bear, these are two types of investors. But tell me one thing. Have you ever wondered that why an investor who is expecting the markets to rise should be considered to be a bull? Why should an investor who is expecting the markets to crash consider himself or herself to be a bear? Why bull and bear? Any idea? What do you say? Why a bull and a bear? Why not anything else? For example, if I have to borrow terms from the animal market, say the from the animal kingdom itself, then can I not say that a person who is expecting the markets to rise is actually a lion or a tiger? What is so special about a bull? Isn't it? Or if you are saying that, okay, here is someone who is expecting the markets to crash, then why not say a rabbit or a hare? Why not that? Why only a bear? Any idea? Why will we consider someone who is expecting the markets to rise a bull and a bear? What is so special about bull and bear? Have you wondered about it? What do you say? Yes, any idea with respect to the same? See, the reason why we are calling them as bull and bear is because of their attacking style. Have you ever seen how a bull attacks? Of course, you may not have a personal experience of it. I'm not really saying that. But maybe you have watched this on television, right? Or you might have watched in some movie how a bull will attack. A bull will rush, right? Let's say if you are standing on a street, the bull will rush to you, pick you by pick you by its horns, and it will, right, it will push you upwards. So that's the reason. Because of the attacking style of a bull, we consider this as, or an investor is expecting the markets to rise as a bull. Because just as a bull is picking up you by its horns and pushing you upwards, this is what an investor is expecting the markets is expecting the markets to rise. And that is the reason we'll consider that to be a bull. Similarly, what is the attacking style of a bear? What do you say? If you're in a jungle, if you're in a forest, and let's say there is a bear who might attack you, how will a bear attack a person? What do you say? Yeah? A bear walks on its four paws. Now, when it will attack you, it will stand on its two paws, put its remaining two paws on your shoulders, and then it will push you downwards. And then don't ask me what happens next. I leave it to your imagination, right? But this is how a bear will attack you. A bear will put its paws on your shoulders, push you down. So an investor who is expecting the markets to go down, expecting the markets to fall, expecting the markets to crash, we will consider that kind of an investor to be a bear. Okay, so bull and bear is basically terms that we are using for investors depending upon what is their expectations in the direction in which the market is expected to move. Right. So the next time, if you read in the newspapers, for example, the markets rise like anything, and you read in the newspapers that bulls have returned back to the market, don't be scared that bulls have returned back to the market. What does that really mean? It simply means that now the markets are within the grip of bulls, people who are expecting the markets to rise. And that is the reason they use this particular term. Yes, there's also one more type of an investor, not that popular, but I'll tell you, one can identify a lot of investors by this term. We can even refer an investor to be a chicken. Now, who is an investor who is a chicken? Okay, we can consider this as a nervous investor. Right, a nervous investor can be referred as a chicken. You have no appetite for the stock market and still you invest in the stock market. You ask anyone who has invested in stock markets, and perhaps this story will be a common story. You have still not invested in the stock market, but that is the time when markets are rising. Markets are continuously rising, and then one fine day you decide that I also want to invest in the stock market, and you plunge into the market. And that very day and that very moment, the markets decide, okay, you have also invested now it is time to fall. So the market comes to know that you have now invested your money, and that is the time. Till now, you were just an observer, right? You were outside the market, you were just seeing that the markets is rising every day, and you feel that you have left out. You feel that you have left out the FOMO, the fear of missing out. And finally, what you do is you enter into the stock market, and the markets decide that it's time to fall. So here is a case of a chicken investor, an investor who is a very nervous investor. So when the markets crash, you are really worried about your investments. Every day the markets are crashing. You're really so nervous. You're not able to sleep well at night. You are like, what did I really do? What was the reason for me to enter into the stock market? And that's how you are feeling. You are very nervous. Finally, a day comes when the markets gradually start rising. Let us say you had purchased some share for 500 rupees, but after you have invested, the share has plunged down to 400. Gradually, the market is moving up. Gradually, the share price climbs up from 400 to 450 to 470. Finally, it reaches your purchase price of 500. And you know what's your immediate reaction? You decide to sell the shares, and you are like, okay, fine. You really feel that now you are relaxed. And the moment you sell the share and you exit the market starts rising again. Yes, if this is the kind of feeling that you get in the stock market, then consider yourself to be a chicken investor, an investor who is extremely nervous. Right. But of course, this term is not that popular, but bulls and bears, that's a very popular term that we discussed. Let's see a few more. Yeah, certain, what we can say, serious ones now. Yes, day trading or a day trader. You should be very clear about day trading, because the next concept that I want to discuss, or the next term that I want to discuss, the understanding of day trading is required. Day trading means buying and selling within the working hours of the stock market on a particular day itself. For example, if today is Monday, right? If today is Monday, then today itself I will buy a share, and today itself I have to sell the share. That means I am doing simply trading. I am not interested in delivery of the shares. If this is what I am doing, I will consider myself to be a day trader. And what I am doing in the stock market will be popularly known as day trading. It is a highly speculative activity that we are doing. You require a lot of experience and a lot of understanding of the stock market to actually be a day trader and do it profitably. Day trading itself is very simple, right? Anyone can buy shares and anyone can sell shares during the day. I mean, during the trading hours of the stock market. But to make money out of it, yes, for that you require a thorough understanding of the stock market, right? If you are a beginner, if you are someone who is still deciding to invest in the stock market, I will absolutely suggest to you that you should not do day trading. It's very risky. Okay. So if yes, but if you are someone who has been doing it, if you are someone who's involved in the stock market since a long time, then fine. Otherwise, day trading, I'll definitely consider that to be very risky. So what are we going to do in day trading? Again, I'll repeat, day trading: buy a share during the trading hours, sell the share during the trading hours. So during the working hours itself, you have to settle your transaction. If this is what you are doing, then we will say that it is day trading. And the final term that I want to discuss in this episode is short selling. Many a times in our later on topic of portfolio management, we will use this term. We will say short selling. So you should very well know what do we mean by short selling. Okay. Short selling, you know what it means? Short selling. It means selling a share without owning the share. That's what we mean by short selling. Yes, very interesting concept. What we say is that we will sell a share which we do not own, right? So I don't have that share in my demat account, still I sell that particular share, then I can say I've indulged in short selling. Now, normally, you know what happens is, normally, the natural order of doing trading normally is that we will first buy and then we will later sell. What do you say? You agree with me? Normally, this is what we understand, that first I have to buy the share and then I have to sell the share. This everyone understands. The idea over here is something in this way, that let me buy, let us say, for 120, and then let me sell it for 160. What do you say? First, I will buy a share for 120 and then the markets rise and I'm selling that same share for 160 rupees. This is the natural order. In short selling, I am changing this natural order. In short selling, what I do is I first sell and then later I buy, right? I first sell and then later I buy. Let me put the figures and it will become very clear. 160, 120. What do you say? Let it digest. I first sell for 160, and then what I sell for 160, I later on buy for 120. Can I say in both the situations I'm making a profit of 40 rupees? Isn't it? In both the situations, I am making a profit of 40 rupees over here. But then the first one is what we normally understand. Okay, it makes sense. I'll first buy a share. I'm expecting that the markets will move up. So I first buy the share. Markets indeed move as per my expectations, and I'm able to sell a share which I have purchased at a lower price at a higher price. And the difference between the two prices is my profit or is my gain. Here, what I do is I am expecting the markets to crash. So I want to encash this situation. So first, I sell the share at a higher price. And when the markets indeed fall as I expected, the share that I sold at a higher price, I cover it up at a lower price. Ultimately, in both the situations, as you can see on your screen, the profit ultimately made is 40 rupees per share. But the first one is considered to be a normal way, while the second one is popularly known as short selling. I didn't have a share in my Demat account, but I saw a good opportunity. I sold the share and then I covered that share at a lower price. Now, how can I do short selling? Now, remember this, short selling is possible, okay? The short selling is possible only in case of day trading. Okay, only in case of day trading. Tell me, what were we doing in day trading? We will first buy a share during the trading hours, and then we will sell away that share during the trading hours. Now, since you have already settled the transaction, there is no question of giving any delivery of the shares. And that is the reason I can very easily do short selling in day trading. I will first sell the share, and then later on, before the stock markets come to an end, that very share which I had sold, I will buy that particular share. Getting it? So what happens is I'm just settling the transaction. See, first I sell. Now, when I sell shares, I have to give delivery to you. But then by the time the day comes to an end, that same share I am buying. So what happens is the transaction of selling the shares gets nullified against the transaction of buying the shares. So you can very well do short selling in day trading. You cannot do short selling beyond day trading. It's not possible. It is simply not possible. The rules of SEBI for stock exchange are very clear. For example, let us say you are buying shares. If you are buying shares, and let's say you are not settling the transaction during the day, so the whatever shares you have purchased, we will find out what is the total money invested, and the total money invested, that's the money that you are supposed to pay. So you are supposed to issue a check and you are supposed to settle that particular transaction. In India, what we follow is a T+2 settlement system. Okay, so in India, we are following a T+2 settlement system. So what happens in this particular system is that you are supposed to do a transaction on a particular day. That is what we mean by T. By T over here means the transaction day and 2 further days. So we will take 2 further days for settling this particular transaction. So let's say if you are doing a transaction, let's say you buy shares on Monday, let's say, as you might be aware, stock markets function from Monday to Friday. Right, the stock markets function from Monday to Friday. So let us say I'm doing a transaction on Monday. So let's say on Monday, just a second. So let us say on Monday, I buy shares. Now a question arises in my mind that if on Monday I'm buying shares, when will the shares come in my Demat account? Right. So Monday and then 2 more days, and finally the shares will get reflected in your Demat account. So Monday is a transaction day, Tuesday, Wednesday. By Thursday, you can expect that the shares will be in your Demat account. That's what we mean by a T+2 settlement system. Right. Of course, it may not be always T+2. Yes, some limitations are there. For example, if you're doing a transaction on Friday, Now, Saturday, Sunday, and Monday, no, that's not how it will work. Saturday and Sunday are holidays in a stock market. They are not working hours. So if you buy shares on Friday, then by Friday evening, you will have to deposit a check for the payment to be made for the shares to be purchased. Forget about Saturday and Sunday. They are closed Monday, Tuesday. Okay, Monday and Tuesday. So we can expect that by Wednesday, the shares will be in your Demat account. Similarly, if you are selling shares, let's say, so if you are selling shares today, right, then within 2 days, the shares will get removed from your Demat account and you will receive the check and the check will get credited in your bank account. So this is how the entire system is working. So short selling is not possible. Please understand this. Short selling is not possible beyond a day. Short selling is possible only in day trading. That's it. Why? Because if you allow the day to get completed, then you will become a part of the T plus 2 system. I sell the shares, for example, I sell the shares today, then I become a part of the T plus 2 system if I carry forward this transaction. And by the end of the day, I will be expected to do the necessary formality, or at least the very next day, I'll be expected to do the necessary formality for transferring shares from my Demat account to the Demat account of the buyer. See, if you have sold the shares, someone has purchased the shares. The person who has purchased the shares has already issued a check for buying the shares. That check will be encashed by you. If you are encashing the check of the buyer, you have a responsibility of delivering the shares to the buyer, isn't it? And now if you argue that these shares are not there in my Demat account, because short selling means selling without owning. I did not have any share in my Demat account, then how will I provide delivery to the buyer? So that's the reason. If you are doing short selling, it is possible only in day trading, or short selling is possible in the derivatives market, right? In the derivatives market, you can carry out short selling. What exactly is a derivative? That's the very next question that will arise, but I'll tell you it is premature for this particular episode to really move into what we mean by a derivative. I reserve that for a later discussion. But these are some important stock market terms that you should be aware about.
Press the bell icon on the YouTube app and never miss another update.